Chances are there's a store in your town that isn't there anymore. And oftentimes it's an entire mall. And maybe it was the place you bought your first toy, or where you got your prom dress, or where you went for your work anniversary dinner. Perhaps it was even a hospital that delivered your kids, or a pharmacy where the pharmacist knew your name. But it's closed. And you probably heard people blaming Amazon, or the pandemic, or just bad luck in a tough economy. But there's another explanation. And this one doesn't get told very often. Quite frankly, it doesn't pay to tell it, since the real pay is keeping it under the surface. Because if you don't know that it's happening, then how can you stop it? This explanation involves a specific set of decisions made by particular interests that made the closing not just likely, but mathematically inevitable. This is the story of private equity. And central to private equity's story isn't what most people think. It's not about profitable businesses, but rather the opposite. Their debt and piling on more. It's about who is doing the piling and who walks away before the bill comes due. The private equity industry controls trillions of dollars in American assets and operates almost entirely outside the public's awareness. And through specific laws and court decisions, it operates in a realm without the restraints most of the powerful entities must abide by. It is a story about money moving from companies to investors, from workers and managers to consultants, and ultimately from American communities to offshore accounts. By the time this episode is over, you'll know that the internet is not the real cause to all of this, and you'll never look at a closed storefront in America the same way again. The pension plans, a matter of trust. To understand how private equity became what it is today, you have to go back to a time before it existed. You have to go back to a world where the pieces were being assembled that created the system that made leveraged buyouts and securitization all possible. To a time when running a business meant running the business to make it grow and provide a more complete value instead of the one that focuses only on the small number of investors at the very top. The year is 1950. The Korean War has just begun, and America is at the height of its post-war industrial power. The steel mills are running around the clock. The auto plants are humming. The great union contracts of the late 1940s have given millions of workers something their parents never had, a defined benefit pension. The promise of that pension was part of what we now look back on and call the American dream. Work here for 30 years, and when you retire, you'll be taken care of. And those pensions were funds often composed of a combination of employer contributions and funds taken out of employees' paychecks going into a single trust fund. And that trust fund was maintained with strict controls, with only the most conservative investments being allowed. And this often meant merely bonds or so-called treasuries. These were considered safe investments, since if a company went under, any bankruptcy proceeding or repaying would have bondholders being those getting guaranteed priority over everybody else. As for treasuries, there would have to be a government collapse entirely for those to come out with no value. And if that happened, I think retirement pension payouts would be the least of anyone's problems. But a law passed in the year that we're focused on right now, the year of 1950, marked the change that would enable everything else that followed. What is prudent? The law that changed everything had a deceptively simple name, the Prudent Man Rule. But to understand what New York did in 1950, you have to go back even further, to a Boston courtroom in 1830, and a judge named Samuel Putnam. A dispute had come before the Massachusetts Supreme Court over how a trust fund should be managed, and Justice Putnam handed down a ruling that would echo through American financial history for the next 2 centuries. He wrote that a trustee should manage money the way men of prudence, discretion, and intelligence manage their own affairs. That became known as the Prudent Man Doctrine, since it came from a court case and not from a law. But it was not the standard way that most of America handled trusts. Instead, a different guideline was a norm and was solidified in a New York case in 1869. The New York Court of Appeals case of King v. Talbot held that fiduciaries in their private affairs do and they lawfully may put their principal funds at hazard, but in the affairs of a trust, they can't. In other words, what is perfectly acceptable when you're risking your own money becomes a breach of duty the moment you are managing someone else's. The moment trust funds went into corporate stock, the safety and hazard of loss was no longer dependent upon the trustees. It had left their control entirely. Afterwards, the state legislature codified that court decision by identifying a list of investments where there would be safe harbor for the trust manager, even if there were declines in value. This meant that there would be no liability. No one could sue them if they invested in that list. And as I identified earlier, this list of safe investments were focused on things such as treasuries and company bonds that carry the strongest measures of safety you could get in any investment. That New York judge and the state legislature afterwards were creating this measure in response to what was happening around the same time. In the year before that ruling, New York City had been consumed by one of the most spectacular financial scandals in American history. The Erie Railroad, which was one of the most essential transportation corridors of the country, had become basically a casino. A small group of financiers, including Jay Gould and James Fisk, had taken control of its board. And in the late 1860s, they issued dubious Erie Railroad shares. They were watering down the stock, and the unsuspecting investors bought millions of dollars worth at inflated prices. When the railroad tycoon Cornelius Vanderbilt tried to wrest the company away from those financiers through legitimate stock purchases, Gould simply printed more shares to dilute him. When the courts moved to stop him, Gould engaged in the payment of bribes to New York state legislatures to legalize what he had already done. Gould personally appeared in Albany with a bag containing $500,000 in cash and handed it out to the lawmakers. One senator accepted $75,000 from Vanderbilt and then $100,000 from Gould. He kept both amounts and then voted to support Gould. You gotta love lawmakers, huh? The Erie was eventually driven into bankruptcy. The men who looted it walked away wealthy, and the investors who had trusted the company's stock lost everything. Stocks, as was seen all too painfully, could easily be manipulated. So the legal lists were to ensure that type of looting couldn't happen to trusts. But by 1950, investment managers and banks were arguing that the Massachusetts minority position, the one where managers basically have free rein to make decisions, especially when it comes to being able to invest in stocks, should be the way New York law should cover it. New York was key because the vast majority of America's industry and commerce was headquartered in that state. This definitely gives a much more stronger meaning to the old saying that if you can make it there, you could make it anywhere. The banks and the investment managers used the argument that trusts and pension funds could make so much more in returns if they could invest in the stock market, especially when facing high inflation, where the fixed return of bonds would provide either no return or slight losses. The pressure eventually worked, and New York passed an amendment to the state's personal property law, instituting the prudent man standard when it came to investments. That change in New York law opened the door for the banks and investment managers to start taking control of America's pension funds. The first pension bailout. Through the late 1960s and into the early 1970s, the bank trust departments were steering pension money into a narrow group of stocks that Wall Street had branded the Nifty 50. These were the blue-chip darlings of the era, composed of companies like Polaroid, Avon, Xerox, Coca-Cola, and McDonald's. The stocks were so good, the argument went, that you only needed to make one decision: buy them and never sell. They were simply one-decision stocks, as the banks called them, and Morgan Guarantee, the single largest manager of pension assets in America, was the institution most associated with identifying and promoting the list. Warren Buffett, not the household name he is today, but still successful at the time, wasn't fooled. As the pension money poured into the Nifty 50 through the late 1960s, he was doing the opposite. In his letters to investors, he noted that the number of attractive investment opportunities was rapidly diminishing. In May of 1969, he took drastic action. He dissolved his investment partnership entirely and returned the money to his investors. He stated, "I am not attuned to this market environment, and I don't want to spoil a decent record by trying to play a game I don't understand, just so I could go out a hero." He understood the game. He simply refused to play it. And it's plain to see in retrospect what Warren Buffett was seeing in real time. At the peak of the mania in 1972, McDonald's carried a price-to-earnings ratio of 86. Disney sat at 82. The historical average for the broader market was around 16. These were exactly the kind of solid, well-run businesses Buffett admired. But at those prices, he wouldn't touch them. A decade later, looking back, he wrote that the prices the stock market placed on good businesses in 1972 looked absurd, and that while high stock prices might make performance look good temporarily, they would ultimately hurt long-term prospects rather than help them. The 1973 fall in stocks was dramatic. During the period between 1973 and 1974, Nifty 50 companies lost anywhere between 50% to 80% of their value from the stock price drops. Pension funds, which had been heavily invested in these stocks, experienced an existential crisis. The gap between what companies had promised their workers and what was actually in the accounts from these losses was almost impossible to hide. On September 2nd, 1974, right in the middle of the worst of it, 3 months before the market finally bottomed, President Gerald Ford signed the Employee Retirement Income Security Act into law. ERISA, as it became known, created the Pension Benefit Guaranty Corporation, the PBGC, and this was sold to the public as worker protection. The official story pointed to Studebaker, which was an automobile company that had closed its plant in South Bend, Indiana, 11 years previously in 1963. It left 8,500 workers with nothing. That was the human face in the legislation. That was the reason Congress gave. But note the gap. It was a decade. 10 years passed between Studebaker's collapse and the law that was supposedly inspired by it. What the official story doesn't usually mention is the Nifty 50 story. The bank trust departments that manage the nation's largest pension funds had spent the better part of a decade steering workers' retirement savings into a narrow group of stocks, those blue-chip darlings. They had concentrated enormous pools of capital into perhaps 50 companies, bid those stocks to 80 and 90 times earnings, and called it prudent management. And one thing hardly gets any mention at all in today's telling. On July 24, 1973, the Senate Finance Committee's Subcommittee on Financial Markets produced a staff briefing document on the role of institutional investors in the stock market. What they found was a system that had fundamentally changed. Institutional investors, the trust departments of large banks and the pension funds and the insurance companies, now accounted for over 70% of the dollar value of all New York Stock Exchange trading. The senators were looking at a market that a handful of institutions had effectively taken over in a single decade. The 10 leading institutional investors alone held over $150 billion in managed assets. Morgan Guaranty Trust, the one that was linked to so many of those pension funds, led the list at $27 billion. The institutions had concentrated in an ever-narrowing circuit of investment choices, which were those biggest stocks. And the Senate found that 14 of the largest 20 U.S. banks had IBM as their single largest holding. The document also noted that a 1968 House Banking and Currency Committee investigation had found the banks managing the pension funds sat on the boards of the companies the pension funds were investing in. They were buying stock in companies they helped govern, with money belonging to workers who had no say in the matter. And all of a sudden, the stocks dropped and the people depending on those pensions saw their pension funds' assets drop along with them. The bank executives and the investment managers, however, had extracted value through not only the management fees, but also through being able to inflate the value of the very boards they sat on. The inflated prices were so obvious to Warren Buffett, he chose to walk away from further investments, at least for a few years, since obviously we know how his investments turned out much later. So Warren Buffett saw it. He saw the crazy valuations in 1969. And the Senate saw the obvious conflict of interest that the banks had in investing in companies where they sat on the boards. But there was something else in ERISA that would matter even more in the years ahead. Something hiding in plain sight inside a law that was supposed to protect workers. Before ERISA was signed into law by Gerald Ford, the legal framework governing pension obligations was, in a word, nothing. An employer could terminate an unfunded pension plan without being liable for any additional pension contributions. If there were insufficient assets to pay all the claims, participants had no legal recourse to demand that employers use company assets to continue funding the plan. Workers who had given 30 years to a company could arrive at retirement and find the promise had simply evaporated. ERISA changed that, or at least appeared to. The Pension Benefit Guaranty Corporation was created to backstop failed pension plans and guarantee at least some benefit to workers when employers couldn't pay. And for single employer plans, the PBGC's obligation to pay benefits took effect immediately upon enactment. The federal government was saying, we will bail these funds out with taxpayer money. From the moment the ink was dry, the federal government assumed responsibility for failed pension plans, including plans that had been underfunded for years and even decades. And of course, the funds that lost value after the Nifty 50 fiasco. The pension funds that had been stuffed with Nifty 50 stocks at 90 times earnings and had just lost half their value in the crash, those prior losses were now absorbed into the new federal guarantee. The slate was wiped clean, pretty much. And the price for that guarantee going forward? $1 per participant per year. $1 per worker per year. That flat rate eventually increased, but the point is this. The federal government basically set a price for bailouts that were inexpensive and made risky investment behavior something that had an established cost. You could technically lose the entire fund and still pay the same set cost for a bailout of taxpayer funds regardless. Beyond that, ERISA did something that received far less attention, but was equally consequential. It took the prudent man standard, that doctrine that New York codified in pension law in 1950, and made it the law of the entire country. One federal standard, superseding the patchwork of state rules that had governed pension investments for decades. It basically allowed any fund in the country to invest their pension funds into stocks. This law wasn't insurance. Real insurance prices risk. What this law and the fund it created did was create a federal backstop with fixed, negligible price tag that bore no relationship to the risk being insured against. After that law was signed by President Ford on Labor Day 1974, the investors controlling the retirement funds of America's laborers got something more significant than any holiday signing ceremony could ever provide. A law that let them keep the profits while sticking the risk and the losses to the workers and to the public at large. The leveraged buyout. The leveraged buyout was always a genuinely risky proposition. This meant that the people taking the risk were the same people exposed to the consequences of failure. But, as you'll see later, that risk reduced somewhat on their end. Jerome Kohlberg, an investor working at Bear Stearns, made deals in the 1960s and early 1970s, operated on private capital from individual investors and from Bear Stearns itself. These were leveraged buyouts, but they were limited. You borrow heavily against a company's own assets to acquire it, use the company's cash flow to service the debt, and eventually sell or take the company public for a return. The company was essentially buying itself, and the investors were betting that the cash flow would hold and they could sell it for a profit. Bear Stearns collected advisory and financing fees at the moment of closing, before anyone knew whether the company would survive. The fee layer was always present. What changed in the late 1970s was not the introduction of fees where none had existed before. It was the explosive growth of that fee layer until fees alone were sufficient to make the deal architects wealthy regardless of outcome. And as you'll see, it also removed who was taking on the risk. This change happened in two steps. The first step was 1974. ERISA created the Pension Benefit Guaranty Corporation, which, as we discussed, backstopped failed pension funds at a premium of $1 per worker per year with no adjustment for risk, at least initially. This did two things simultaneously. It basically removed personal liability for losses, and it set a cost, set a limit, a floor of how much you could lose even if you lost the entire fund. Because if you pay a fee a fraction of the size of the fund, you get it backstopped by the federal government. But the second step in 1979 was the biggest. The Department of Labor issued its final investment duties regulation, clarifying that ERISA's prudent man standard required pension fiduciaries to evaluate investments not in isolation, not by themselves, but as part of the overall portfolio. Because if you look at an individual leveraged buyout, there's no other way to look at it other than being risky. You're using debt right off the bat just to buy it. But after that change to look at the larger picture, the portfolio picture, there was an explosive growth in pension plans being put into leveraged buyouts. This meant that you could counterweight something that was genuinely risky by simply adding something safe within the same portfolio. Presto changeo, something risky and a potential liability becomes a balanced portfolio after you move a few things around. Also, take note of that phrase, buyout funds. The same regulatory door that opened for Silicon Valley startups opened for leveraged buyouts as well. At least, that was the interpretation that came from this rule. 2 years later, in 1981, George Roberts of KKR tapped Oregon's Public Employees Pension Fund for over $170 million to finance the leveraged buyout of Fred Meyer. Soon, other state pension funds signed on. By 1986, 11 state pension funds were partners in KKR equity pools. When KKR initiated its $5.6 billion fund in 1987, those 11 pension funds provided 53% of the money. So this means that the buyouts that loaded cherished and valued American companies with debt and drove them into the ground were being done with pension funds. The pension funds is what made it possible at this massive scale. Before the pension fund money entered the picture, the leveraged buyout, as we looked at, was a boutique strategy. It was constrained by how much capital wealthy private investors would commit. That constraint was no more. After 1979, the resources used to take down massive American companies, successful American companies, was the entire retirement savings of the American workforce. The 401k trick. But pension money flowing into stocks was only the first mechanism. The 1978 Revenue Act added Section 401k to the tax code. That created the legal framework for defined contribution plans to replace defined benefit pensions. Before we continue into the 401k trick that made leveraged buyouts even more leveragey, we need to distinguish between a defined contribution plan and a defined benefit pension. Don't worry, it's not going to get very complicated. At least I hope not. A defined benefit pension is what most people think about when they think about pensions. It's the type of plan that was run by the big automobile manufacturers in the 1950s and onward. The employee would have an amount taken out from each paycheck, and the company, GM or whoever, would also pay into it. And when you retired, you received a payout every month from that pension. The amount was calculated by a formula based on your years of service and your salary. You didn't manage investments. You didn't make decisions. You simply showed up, you worked, and the promise was kept. And critically, if the fund performed poorly, or if the markets crashed, or if retirees lived longer than expected, that was the employer's problem to solve. The employer bore the investment risk permanently. Your check arrived regardless. A defined contribution plan, however, was different. This is what the 401k was, and still is. It was basically you contributing to an account that had a level of tax exemption status, and the company would match what you paid into it. That sounds similar to a pension, but the employer's liability ended the moment that matching contribution was made. The company wrote its check and then walked away, meaning that every time you paid and the company matched it, basically you guys were even. Whatever that money grew into, or didn't grow into, was entirely your problem. Bad markets the year before you retired? Your problem. Poor investment choices over 40 years? Again, your problem. Outliving your savings? Oh, that's a big problem. The guaranteed lifetime income was replaced by an account balance that could rise or fall with markets you didn't control, based on investment decisions you often didn't fully understand, with no floor beneath it if everything went wrong. That part seems to get lost in all the hype about 401ks. I wonder why. When a private equity firm acquired a company and terminated its defined benefit pension plan, the traditional pension, two additional mechanisms were activated. First, if the fund was overfunded, meaning that it held more than was needed to cover the promised obligations, then the surplus could be recovered by the acquiring firm after paying off the workers' benefits. This was, and still is, oftentimes accomplished typically by purchasing the cheapest available annuity contracts to cover the monthly checks. Using annuity is basically the company going to an insurance company, them pricing out the cost, and then that company providing a lump sum, and then now it's that insurance company is taking on the obligation to pay those monthly payouts once the retirement happens. The surplus in a leveraged buyout situation went directly to service the acquisition debt. The workers' own accumulated pension contributions became acquisition financing for the leveraged buyout. I'm going to take a pause and let you think about that for a second, because this means that portions of the money that was paid for the express purpose to fund employees' retirements now became money that partially paid for an outside company to load more debt onto that company and then run it into the ground. I mean, it's just ridiculous. I'm going to go ahead and give you a second because I think I need one too. Okay, the second mechanism, which involves the 401k, gave the private equity firm that now owns the company a cheaper replacement to the traditional pension they just ended. This transferred all the investment risk onto the worker and capped the employer's liability at fixed contributions. The defined benefit obligation, with its permanent employer liability and the government bailout we talked about earlier, which did come with some strings attached, could now be taken completely out of the picture. Between 1980 and 1987, pension raters removed more than $17 billion of pension funds from plans to bankroll takeovers and leveraged buyouts. I'll just note that surplus was based on what math you used, And well, it seems every year there's all kinds of new math. I guess maybe that's why you have so many mathematicians and people that would go into physics go into finance instead. What all this meant was simply that the people taking the risks with the funds were no longer the same people absorbing the consequences. And the fee structure made sure that the private equity firms came out winners regardless of what happened to the company they just bought. Case studies, before and after. Before the 1979 regulatory change that we talked about earlier, there was a company called Cobbler's Industries, and it was taken over by Kohlberg, the person we talked about earlier at Bear Stearns, in 1971. It also went by the name of California Cobblers and had operations in California and also, I think, a factory in Pennsylvania from at least what I could find. It was a shoe manufacturing company that was actually quite successful. A lot of people saw it as a new type of shoe in America, a kind that was a little bit more relaxed and laid back, at least when you compared it to the main styles at the time. It had real assets and real cash flows. It was, at least on the surface, successful. And it was precisely the kind of company Kohlberg's model specifically targeted. A family-built business whose president was likely either the founder or deeply connected to the founder's legacy. The deal was done with private capital from individual investors and from Bear Stearns itself. There were no pension funds involved, at least on this one as far as I could tell. But regardless, it was loaded with debt in this acquisition. It placed obligations that the company and its cash flow just simply couldn't sustain, apparently. Newspaper reports stated that the founder, Walter Braun, jumped off the roof while executives were there visiting in May 1972. Later on, Cobblers went bankrupt. I couldn't find much more details than that. It's kind of a sketchy situation. The human consequences, though, were pretty evident, regardless of what I could find in detail. The human consequences reached all the way down. A family business was gone, and a president was dead, and workers were now without jobs. There was nowhere to hide and no structure to retreat behind. It was tragic, but it was confined to a private company with a workforce in the hundreds. But the boundaries of the consequences of leveraged buyouts would widen, much more than that, because the future companies wouldn't just be private companies, and the workforces wouldn't be in the hundreds. They'd be in the thousands. Now for the after 1979 regulatory change case study. For this, Toys R Us probably provides the best case study. In 2005, KKR, Bain Capital, and Vornado Realty acquired Toys R Us in a $6.5 billion leveraged buyout. They financed 80% of the purchase with debt, while contributing only a portion of it with their own capital. That debt was placed immediately on the company's balance sheet. KKR was a firm founded by Jerome Kohlberg and a couple of partners in 1976. KKR basically stands for the initials of the three founders, with Kohlberg being one of them. And they all came from Bear Stearns, which of course you might recognize Bear Stearns from the context of the 2008 financial crisis because they were one of the firms that just failed completely. And not surprisingly, pension fund money was used in this. They raised their investment funds from limited partners, and those limited partners were composed of pension funds. The Minnesota State Board of Investment, the Washington State Investment Board, CalPERS, these were all investors in KKR's funds. When those funds invested in Toys R Us and the equity was wiped out, it was pension money that absorbed the loss on the limited partner side. The general partners had a different experience. While 33,000 employees were out of work and the pension funds took a hit, KKR, Bain Capital, and Vornado collected over $400 million in fees and interest from Toys R Us during the period they owned the company. And the reported contract details sound pretty sweet. The private equity firms were to collect $15 million annually, and that amount increased 5% each year that they had stake in the company, with no minimum hours of service required. Imagine. $15 million, regardless of what work you do. I love it. Well, if I was getting the money, and it didn't cost people their jobs, or Toys R Us. And the free stream kept running while the company died. The pension funds absorbed the equity loss. The workers lost their jobs and their severance. The private equity firms collected their fees regardless of the outcome. This is the system that developed, starting slowly in 1950 and moving our way up through the 1970s. And then it becoming mainstream. I mean, you had movies that are evangelizing this kind of activity, when in reality it was hollowing out America. Our manufacturing base, our retail space, our third space, gone. When you remove personal exposure from bad outcomes, basically the accountability, you export the responsibility for failure to the taxpayers, through federal guarantee, and then open the largest pool of capital in the country to the highest risk investment vehicles, you get the ever-increasing abandoned storefronts across America. The internet didn't take down Sears or Toys R Us. And if somebody wants to argue otherwise, I could demolish that notion just with one simple fact. Toys R Us was making operational profits up until bankruptcy. They were profitable. They were profitable until the end. What did them in was the debt and the dividends and the fees. It's fairly difficult when the person that buys you out and says, well, I'm going to make you better, loads you up with debt from the day one. Not just any amount of debt, billions of dollars of debt. Toys R Us's business wasn't bad. The buyout was. Junk bonds. By 1985, the leveraged buyout had graduated from a niche strategy practiced by a handful of specialists into something that was beginning to reshape entire industries. The deals were getting bigger, the fees were getting larger, and the debt ratios were reaching levels that would have seemed crazy a decade earlier. And at the center of all of this, operating out of an office in Beverly Hills that he treated more like a trading floor than a banking operation, was Michael Milken. Before Milken, the bond market was a gentleman's club. Investment-grade bonds were issued by established corporations and held by insurance companies, pension funds, and the banks. Below investment-grade bonds existed, but they were almost entirely fallen angels, companies that had once been creditworthy and had declined. Nobody issued new debt below investment grade. Nobody underwrote it, and nobody dared build a market for it. The institutional buyers who controlled the capital were largely and practically prohibited from touching it. Milken, though, changed all that. He built a market for newly issued below investment grade bonds from scratch, creating both the supply, which he convinced companies and deal makers that they could raise capital this way, and on the demand side by persuading institutional buyers that the yields justified the risk. He was, all at once, the dominant underwriter, the dominant trader, as well as the dominant investor in the market that he had created. At its peak, Drexel Burnham Lambert controlled an estimated 60% of the entire high-yield bond market. And Milken used that position to do something that transformed the economics of leveraged buyout. He created the highly confident letter. Before the highly confident letter, leveraged buyout deals were constrained by how much financing a buyer could actually commit to at signing. You couldn't bid for a company unless you had the money lined up. Lining up the money took time and limited how large the deals could be. The highly confident letter was Milken's solution. It was a letter from Drexel stating that the firm was highly confident it could raise the financing needed to complete a proposed acquisition. Basically, it said we can do it because, we made this letter and we believe it. The effect of this basically meaningless letter was extraordinary. Suddenly, a buyer could make a binding offer to acquire a multi-billion-dollar company with nothing more than Drexel's confidence behind it. But the devil is in the details. It always is. The financing would be raised afterward by Milken's network of junk bond buyers. The constraint on size of these leveraged buyouts pretty much disappeared. And one major consequence of bigger deals meant, this. The larger the deal, the more debt could be loaded onto the target. The more debt on the target, the larger the dividend recapitalization could be. And the larger the dividend recapitalization, the faster the buyers could extract that company's capital. This was important since it allowed more to be taken before the debt obligations began to choke the company and the institutional investors. And this was important because at some point it becomes obvious that the company cannot survive. And you start having those investors start having second thoughts. The window between acquisition and extraction was the entire business model. In 1986, Milken earned over $200 million. In 1987, he earned $550 million. This amount wasn't a salary. It was from profits from a combination of trading deals, underwriting fees, and very complicated compensation arrangements. The IRS had never seen numbers like this from a single individual who was not the owner of a major corporation. Milken was not the owner of anything but supposedly just a deal maker. Yet he made more money than the CEOs of the companies his deals were destroying. The language of this time in the 1980s was revealing. You heard names like raiders and sharks and locusts. These were the words that the workers and the journalists used. The ones running these operations, however, had different terms. They spoke of unlocking shareholder value or eliminating inefficiency, or imposing the discipline of debt on complacent managements. They even claimed that what they were doing was good for the economy. Michael Jensen, a Harvard Business School professor, published a paper in 1989 arguing that the leveraged buyout was not a threat to the American economy, but its salvation. Managers of public corporations, Jensen argued, were spending shareholders' money on empire building and inefficiency because they faced no discipline. Debt imposed discipline. The obligation to service a large debt load forced management to maximize cash flow. It forced them to eliminate waste and to focus on core operations. The leveraged buyout was not extraction, it was optimization. Jensen's paper was titled Eclipse of the Public Corporation, and it argued that publicly traded companies were becoming obsolete. But as we see from the effects, from the collapse of so many America's successful and beloved companies, it's hard not to see leveraged buyout as nothing but sheer dismantling. Jensen's theory gave the industry intellectual cover, and the industry used that cover and anything else it could in congressional testimony and in press releases and in the business school curricula that were training the next generation of dealmakers. While the theory was being constructed, the deals kept getting bigger, and the company failures kept getting bigger. In 1988, KKR made a bid for RJR Nabisco. That was the tobacco and food conglomerate that had recently moved its headquarters to Atlanta. The bid set off a frenzied auction that drew in every major private equity firm and several investment banks. KKR won. The final price was $31 billion. It was the largest leveraged buyout in history, and it would remain so for 17 years. The deal required so much debt that Drexel and KKR had to essentially invent new financing structures just to accommodate it. The interest payments alone would consume a significant fraction of RJR Nabisco's annual earnings. The company that emerged from the transaction was not stronger or more disciplined. It was a company that would spend the next decade gradually dismantling itself, selling brands, cutting research, and laying off its workers. And doing this all in a desperate attempt to service the obligations it had never chosen and never needed. When I look at what happened to RJR Nabisco, I can't help but see what happened to Sears a few decades later, with its real estate being sold off and even its legendary tool brand, Craftsman, being sold off to a Chinese company. The RJR deal demonstrated that the model worked at almost any scale. It showed that you could load $30 billion of debt onto a functioning American corporation, harvest enormous fees from the transaction itself, and walk away enriched regardless of what happened to the company afterwards. And that message was received loud and clear. In 1985, Blackstone was founded. In 1987, Carlyle. In 1984, Bain Capital. The industry that would collectively come to control trillions of dollars in American assets was assembling itself, deal by deal, fund by fund, through the second half of the decade. And then there was a crash. The S&L, or the savings and loan crisis, had been building throughout the 1980s. A lot of the savings and loans companies loaded their balance sheets with below investment grade debt, those junk bonds we talked about earlier. When the junk bond market began to wobble in 1989, the S&Ls collapsed. When Drexel Burnham Lambert collapsed in February 1990, which was undone by Milken's fraud charges and the evaporation of the market he had created, the S&Ls went with it. The federal government paid over $150 billion cleaning up the savings and loan crisis. Actually, correction, the federal government spent over $100 billion of taxpayer money bailing the raiders and banks out. Sadly, it was part of a pattern that would repeat itself at least twice more in the coming decades. And if you look at the larger picture, the mechanics of this, money going into a risky bet, and it going into it for years, and then finally all that money evaporating, it looks a lot like what happened with the Nifty 50. And it looks a lot like what happened in 2008 with the securitized mortgages. And the word leveraged buyout became so toxic that eventually the industry rebranded itself. It called itself private equity. The name change was strategic. Leveraged buyout described a financial technique, a way of structuring a transaction. Private equity described an asset class of institutional investment with a long history and a better pedigree. By calling themselves private equity firms, they tried to make themselves look respectable. They tried to distance themselves from the patterns that they kept repeating in the 1980s and even into the 1990s. But the era of private equity ended up looking just like the leveraged buyouts of the 1980s. Instead of RGR Nabisco, it was Sears. Instead of Safeway, it was Payless Shoes. Regardless of the names on the storefront, the companies, and in some cases entire industries done in by the leveraged buyouts, were more than just brick and mortar stores. They were composed of employees, supply chains, managers, and loyal customers who look forward to every visit. America lost tens of thousands of jobs and hundreds of billions of dollars from our economy. And the vast amount of all that money that went out of people's pension funds and investment funds, they went to select groups within Wall Street, and the remnants of the brand sold off for pennies on the dollar, often to foreign buyers. Just like Craftsman tools going to China. Many of these stores actually had operational profits even to the very end. The debt and dividends and fees that had no basis for existing went to the so-called investors who acquired them and redirected them to bankruptcy. They'll say the companies were simply not efficient. But you've watched this episode, and now you know that's simply not true.